I know you've seen it before. Your setup looks perfect. Price is moving so well in your direction. You enter the trade, you set your stop loss so confidently, and then boom. One quick spike, your stop loss is gone, and it moves right back into your direction. And it hurts because you were right all along. It's not the brokers hunting your stops, it's something much more calculated. Something the pros understand, but you don't. Right there, hidden between three candles is what we call a fair value gap. A tiny pocket of imbalances that institutional traders exploit every single day. It's a magnet that pulls price in its direction every time, leaving traders with losses. And here's the part 99% of traders completely miss. Inside the gap is the entry, the timing, and the context that pros use to milk the markets daily with sniper precision. By the end of this video, you'll know exactly how to spot these gaps, how to trade them like an institutional trader, and how to stop being the liquidity and start making money from it. Let's keep it simple. A fair value gap, or FVG, is a zone on your chart where the market basically skipped over price. Price displays so aggressively that it left a gap here, showing us that the buyers are the one controlling the market and the sellers are the one being squeezed. Also, that gap shows where some orders didn't get filled. Buyers or sellers were ready, but the market just raced past them. Later, price often comes back to fill those zones because the market naturally wants to fill those areas with low volume. Here's the fascinating part. These gaps are far from being random. They are footprints left by the big players. Banks, hedge funds, institutions moving massive volumes of orders with precision. These gaps highlight areas of liquidity where stop orders, pending orders, or unfilled trades are stacked. Price often reacts strongly when it returns to these zones, either reversing or continuing the move. By understanding and spotting for value gaps, you're not just looking at random moves, you're gaining insight into the behavior of the market's biggest movers, giving you a true edge in anticipating where the next price move will happen. In short, fair value gaps are the market's way of balancing the books, and learning to read them is like getting a sneak peek behind the scenes of institutional trading. But here's the catch. Not every gap is a free money setup. Some will trick you, some will get disrespected, some will get respected. So let me show you how to spot them in real time. So how do you find the actual gaps that matter? So what is a fair value gap? A fair value gap is a 3-candle pattern where the up wick of the first candle doesn't touch the down wick of the third. This tells us that the buyers were so aggressive inside this range that they didn't give a fair exchange to sellers. So right here, we know that buyers are the one controlling the market and the sellers are being squeezed. So the next time price has the chance to come back towards this zone, those buyers will most likely defend their positions to create new highs. One thing I'm also looking at to see how strong this fair value gap actually is going to be is how this third candle closes above the second candle's high. If we have a big strong candle closure above the second candle's high, it tells me that the buyers are accepting higher prices, and when price will go back down towards the gap, we will most likely create new highs. But if that candle right here, that third candle, closes back inside the range of the second one, then this fair value gap becomes a little bit lower probability. In those cases, you could see price absolutely disrespecting this fair value gap, so watch out on how this third candle closes. If it closes strong, you have a lot of chances of respecting the gap. If it closes weak, you could possibly disrespect and create an inversion gap. Now let's do the bearish scenario. A bearish fair value gap is a 3-candle pattern where the down wick of the first candle doesn't touch the up wick of the third. This tells us that the sellers were being so aggressive that they didn't give a fair exchange to buyers, so now this area becomes an area with low volume. So when price will come back towards this area, sellers will most likely defend their positions to create new lows in the market. So this is how you get a bearish bias from creating bearish fair value gaps. Same tip to increase your win rate, watch out for how this third candle closes. If it closes strongly below the previous candle's low, so the second candle's low here, it tells us that the sellers are accepting lower prices and they will most likely defend their position once we pull back towards this gap. But if this candle fails to close below the previous candle's low and create some sort of reversal patterns, this is when you could see that fair value gap being ran through and being disrespected. So those kind of scenarios, you want to watch out for them, but you want to be trading the ones that closes strongly below the second candle's low. You also want to look for fair value gaps that flow in the direction of the trend. Like in this example, we have a bullish trend, so we're rejecting lows, breaking highs, and this is the moment where I want to look for those bullish fair value gaps to get created, and I want to see them being respected in order to create new highs in this market. So here you guys see we shifted above this high, we're rejecting lows, breaking highs, and this fair value gap held in order to create new highs. Even if you don't want to hear this, size does matter too. The bigger the gap, the more unfilled orders are likely sitting there. Small gaps can easily get absorbed by normal market fluctuations, creating false signals. But a large gap, that's a clear signal that smart money made a move and it's worth your close attention. Treat these zones like magnets. They often pull price back to fill them, but they also push price back in the same direction as the gap being created. But seeing a gap is not enough. How do you know it's actually a valid fair value gap? That's where most traders fail. Stay tuned because this is where you'll see what you are missing. Not all gaps are created equal. Here's the validation checklist to separate the signal from the noise. Number 1, you should take your trades in the premium zones of the fair value gap for selling trades and in the discount zone for buying trades. So let's say in this scenario, we are bullish because on the higher time frame, we're rejecting lows, breaking highs, and we're also creating bullish fair value gaps, disrespecting bearish fair value gaps. So here, I know that those gaps here inside this range will most likely hold to create new highs, but which one has the highest probability of seeing that happening? So here, I have a gap right there, which is pretty big. I have smaller gaps up here. So the question is, which one will hold? So now this is the moment where I can take out my fib from this swing low to this swing high, and basically I can see that those gaps sitting up here are in premium of a bullish range. So I do not want to take those fair value gaps here because the risk to reward of them is way too low, and we have a lot of chances of seeing price pulling back to 50% of the previous range to fill extra orders to then bounce back to the most recent high. So here, the highest probability for value gap inside this range is the one sitting at discount of a bullish range, and also is this one because it is twice as big as the ones above them. So now I will wait for price to come back towards this fair value gap with my stop loss below the swing low here, and I will target the most recent high for a 1 to 2 risk to reward. As you guys can see, this fair value gap was the one being respected because it was at the discount of a bullish leg, and all those gaps here at premium got disrespected because this is a price level that the sellers will be attracted to since we're at premium. Number 2, if there is a prior mitigation of a bearish fair value gap, in this case, you want to wait for us to trade above the highest swing point that traded inside the gap. So here in this case, if price comes back and trades close to that high but doesn't sweep that high, I will not look to go short because these are equal highs, and I never try to short equal highs. In this case, I would want to wait for price to sweep this internal high into this bearish fair value gap, and now this is the moment where I would look for potential short opportunities, because as soon as we trade above the highest high that mitigated that gap in the first place, then I know liquidity has been taken out, and this is a good confirmation to look for shorts. But why should you do this? Have you ever wondered why some fair value gaps hit your target perfectly while others seems to fail for no reason? The secret isn't the gap itself, it's where the gap actually is on the higher time frame. Every pair has a fair value somewhere. In an uptrend, areas above the current price are considered premium zones. These zones are like buying the latest gadget at full retail price. Sure you can, but you're paying at premium and the risk is high. Entering a trade here often feels like you're chasing the market. On the same hand, areas below the current price are the discounted zone. These are like catching the same gadget on a massive sale. The risk is lower and the probability of a positive outcome is high. Trading in the discount or premium of these fair value gaps align perfectly with price efficiency. Why? Because institutions often leave liquidity in these areas, and price naturally gravitates back to fill these gaps. So imagine if you're taking a buy trade and you're taking the trade in a discounted zone of the fair value gap. It's cheaper for the market to fill that trade in this exact zone, and it has a lot of chances of seeing price reverse in this exact area and continue that trend. This concept is what will easily put you in flow with those massive institutional impulsive moves. Now let's take a look at this scenario. As you guys can see, we are absolutely bearish because we're rejecting highs, breaking lows, creating shifts in market structure on the downside. So right here, when we create those bearish fair value gaps, I always ask myself, where is the discount of the previous range or the premium of the previous range. So here, since we are creating bearish fair value gaps, I would lean bearish and I would look for shorts in order to create new lows, because I know the sellers are the one controlling the market. So in this case, where is my fair value gap? It is from this first candle's down wick to this third candle's up wick. In this zone, there are many sellers waiting to defend their position. So now, do you enter blindly off of the lower portion of that gap, predicting that price will most likely create a new low? No, because it will not give you the best risk to reward. What you want to do though is take out your fib tool and look for the discount of the previous range. So here, from the swing high to the swing low, you search for that 50%, and when you see it, this is the exact area that will most likely create the reversal and will be the most precise area to enter on. So in this exact area, this is where you want to take shorts, stop loss right above this candle's high, and take profit at the internal low to predict that the sellers will defend their positions to create new lows. So here in this case, see how we reacted to that 50%. Those sellers were extremely reactive to that 50%. And if you entered in the bottom portion, then you would have had to deal with a lot of drawdown and maybe even forced to get out of a potential winning trade. A lot of traders try to buy the top of the trend, which is premium, and sell the bottom, which is also discount. Unfortunately, it doesn't work that way, so try this to cut down all the unnecessary losses, especially if you pair it with top-down analysis. Now let's take a look at a scenario that I took in real time. As you guys can see in this case, I am leaning bullish because we're rejecting lows, breaking highs, and we're also creating bullish fair value gaps while disrespecting bearish fair value gaps. So here, I saw that we created that fair value gap in what? Discount of the previous range, especially below that 50%, which was in the golden pocket, 61.8, 78.6. So right here, this fair value gap was the sweet spot for me because I could put my stop loss right below this candle's low and having that high risk to reward play. So as you guys can see here, we had multiple opportunities inside the same range. So inside this 5-minute fair value gap right here, and also this one being right there, because if I can take my fib again from this swing low to the swing high, we pulled back again towards 50% of the previous range, giving me another buy opportunity right there, stop loss right below this candle's low, and take profit to the upside. Now, unfortunately, I took this trade a few days ago, but I feel like I should have held this trade for longer, but I didn't, because as you guys can see, the market kept going higher, but I truly believe that if you get a piece of the pie, you should be content and move on. So if you want to put this all together, the step-by-step process to trade a fair value gap like a pro, the first thing you need to do is identify the trend. If it's an uptrend, look for bullish fair value gaps. If it's a downtrend, look for bearish fair value gaps. Then you want to spot the gap. So a bullish fair value gap is a 3-candle pattern where the up wick of the first candle doesn't touch the down wick of the third, telling you that the buyers are the one controlling the market. The bearish fair value gap is where the down wick of the first candle doesn't touch the up wick of the third, signaling that the sellers are controlling the market, and if we pull back towards this gap, we have a lot of chances of creating new lows. Then you want to check for discount and premium zones. If you want to look for longs, never buy a premium fair value gap. Always wait for price to come back towards 50% of the previous swing range and go for longs. Same thing for a bearish scenario, you want to look for a premium zone, so 50% and above, to short the market to create new lows, because this will give you the highest risk to reward play and you will have a tight stop loss. Then you want to validate the gap. If the fair value gap already got mitigated, you want to wait for price to get above the highest swing point that mitigated a bearish fair value gap. If the fair value gap was bullish, you want to see price getting below the lowest point that mitigated that bullish fair value gap to see some upside. Also, the size of the gap actually matters, and the bigger the gap, the more substance and the more buyers/sellers located inside this gap. And then you can enter the trade once all conditions are met. You can place your stop loss just beyond the extremes of the fair value gap to limit your risk. Then you can set your target. A safe target is either the next swing level or the previous premium zone. Aim for at least 1 to 2 risks to reward. The key here is the patience. Do not rush. Gaps are about probabilities and not guarantees. You want multiple confirmations before committing your capital. So to recap, fair value gaps are skipped zones where liquidity awaits. Validate them using trend, discount, premium, prior mitigations, and structural breaks. Wait for confirmations to enter carefully, manage your risk, and always trade with the trend. Master this and you'll spot high probability trades before the market even notices. If this video helped you see fair value gaps in a new way, hit that like button and subscribe to the channel. In the next video, I'll show you a live fair value gap trade from start to finish so you can see exactly how it works in real time. Trust me, you don't want to miss it. Much love and peace out.